So this is Christmas, and what have you done? The old line to that song that we've all probably heard a million times before on the radio this time of year came across my mind recently because this is the charitable giving season. A lot of my clients have been asking questions or have seen things on the news or perhaps heard on the radio about ways to give charitably. So in today's Financial Prof video, we're going to talk about my 3 favorite ways to charitably give as we approach year end. Hi, I'm John Norberg and welcome to the Financial Prof series. So 3 of my favorite ways to give, right? So we're going to cover these not in any extreme depth, but just give you an idea of how each one works. And then hopefully this is something that you can then take back and use maybe one, maybe multiple of these as you're considering your strategy for how do you want to support those less fortunate. So first and foremost, a lot of people can take advantage of this one and have never even heard of it. The QCD, or Qualified Charitable Distribution. So what is this? Basically what it is taking money from your traditional IRA, 401k, SEP IRA, etc., and then giving it to a charity. It could be any 501c3 organization out there, and it's tax deductible. You can do so if you're age 70 and 1/2 or older, and if you're in RMD, or required minimum distribution stage, so in other words right now that would be 73 or older, then you are going to be able to count that amount that you're distributing charitably as credit against the RMD. So let's say your RMD this year is $50,000, but you don't really need the money. You could give that money charitably by way of the Qualified Charitable Distribution, and it would count against the RMD, and it goes directly to the charity in full. So meaning no taxation, because it goes directly from your IRA to the charity. Pretty awesome, because for a lot of people who are in that age group of older than 70 and a half, they don't even know about this, but it's a way to increase their charitable giving by whatever their tax bracket is. So maybe this is you. Maybe your tax bracket is 24% plus whatever your state is. Anytime you write a check from your IRA as a qualified charitable distribution, and there's a way to do that, then it's basically bumping up that charitable contributions giving power by 24% because it's not taxed, unlike, say, what you pull out of your wallet when you give at church on Sundays, right? So again, that's a qualified charitable distribution. One quick caveat is that you can give up to $105,000 per year, but if you have a spouse, great news, that spouse can also give $105,000 for a max of $210,000. Again, back to the RMD real quick, we talked in a very recent video about the hidden tax bomb inside of your 401k or IRA, and this is the RMD, right? Quick spoiler alert, that's exactly what we talked about in that video. And if you use the QCD, that qualified charitable distribution, it's a great tool to be able, let's say, you are in that stage of distributing and you wish you had done something about that RMD, but now it's a little late for that. You can use the QCD as a way around that RMD because now you're giving to charity instead. So again, number 1, the Qualified Charitable Distribution, or QCD. Number 2, the Donor Advised Fund, or DAF. We like 3-letter acronyms, TLAs, a lot, right? So this one is basically a fund where you give money, oftentimes out of a taxable account, and that money is now counted as a deduction. So by writing a check to your donor advised fund, it is now deductible to you immediately in the tax year that you write that check. It's a really good way to give a highly appreciated stock position, for instance. This is something that I see a lot where people are able to write off the amount of that stock appreciation, as well as now they can not have to ever recognize the gains on that stock position. Plus, they're able to have some say over how those funds are distributed. And they don't all have to be distributed in the current year. Rather, they can be distributed over a series of years. So even though you gave that donation in a single tax year and thereby get the write-off in that single tax year, that can be distributed over a series of years. Basically, that's why it's called a donor advised fund, right? Because you're giving it irrevocably to a fund that you advise, and that fund is now giving charitable grants based on your advice. You tell the fund manager, in our case, say Norbert Wealth Management, you tell us how you want those funds distributed, and how much per year, right? And by so doing, you're able to now give quite a bit of money. Say you sold a business, this is a common one I see, in 1 year and get that tax write-off. But now make your charitable contributions for the next decade, 2 decades, 3 decades plus out of that single pot of money that you thereby used. And that money's also growing tax-free in the meantime because ideally you've invested it, right? So again, that's the donor advised fund. Last but not least, the private foundation, specifically the private family foundation. So this one bears some similarities to the donor advised fund, but it's different in a few key ways, right? So you usually fund it with a large upfront donation for which you typically do get a write-off. And there are a few rules around how that write-off works with the foundation, so good to consult a CPA and a wealth manager typically. But we handle family foundations here at Norberg Wealth Management, and one of the benefits that people really seem to like about them is, unlike the donor advised fund where technically you're only advising, although typically that advice is followed, on the family foundation, you, the donor, can also serve as the trustee on the fund and thereby maintain control over the investments and the management thereof. But again, remember, this is a charitable vehicle, right? So typically the foundation is charged by the IRS to give at least 5% of their assets away per year, and they can be to any number of different causes, organizations, or even individuals. One of the other key benefits about the family foundation, again, you're remaining in control of these funds to a certain extent, right? Which also means that in addition to having some say over how those funds are distributed, you also are able to put family members of yours on the foundation's board. Meaning, let's say you have a son or a daughter or both who they do well in life, but maybe they would benefit from having a position on the board where you can pay them a reasonable salary plus any travel expenses, etc. And again, you're maintaining control of these assets, which is typically the big reason people do foundations, right? That's where this might be the vehicle of choice for you. So again, that's the family foundation. The drawback that a lot of people tend to like less, although some people see it as a plus because you do get that publicity, is that the family foundations do have to, like every private foundation, disclose their donations. So this is all publicly available information. If the foundation makes a grant of any kind to someone or an organization, that is publicly available info. So that is one drawback, but it can be a really good estate planning tool too, because these assets, again, irrevocably given, are out of your estate, so no estate tax need apply. So if any of these three, again, the Qualified Charitable Distribution, the Donor Advised Fund, or the Private Family Foundation, appeal to you or pique your interest as we enter into this season of giving, then please drop us a line. We'd love to find out more about what your goals are and see if we at Norberg Wealth Management can be of some help. And in the meantime, I'll see you out there.